Here's a promise that I can make you. By the end of this video, you'll be able to explain the difference between a PE fund, a VC fund, and a hedge fund to your 85-year-old Ajji. Let's get right into it. So before we get technical, right, it can really help to understand where something stands in the big picture. All of us have heard of the stock market. Stocks, equities, and shares are all different ways of saying the same thing. They're used to refer to parts of a business. When these parts are traded over a stock exchange, we refer to them as public equities. So what happens if I own parts of a business that is not traded on a stock exchange? Haha, then I'm dealing with private equities. And where do hedge funds fit in this whole equation? They definitely don't invest in startups, but they do invest in companies that are generating profits. And more often than not, these profitable companies are traded on the stock exchange. Hedge funds also implement strategies that don't necessarily come under the equity umbrella, such as trading in currencies, bonds, and other more complicated products. So just for the sake of simplicity, let's put hedge funds under the "it's complicated" section. However, if you do think of hedge funds, think of short-term investments that can be traded easily. This ease of trading is known as liquidity, by the way. And if you're thinking of long-term illiquid investments in private companies, then you're probably thinking of private equity or venture capital. So now let's zoom in and get a little more detailed. Let's talk about private equity fund. As we mentioned earlier, the term private refers to non-public and equity refers to shares of a company. Private equity funds collect money from investors and then invest this capital into private company. Generally, this is done by using a mechanism known as a leveraged buyout. So what is a leveraged buyout? An LBO is the acquisition of another company using a significant amount of borrowed money. The assets of the company being acquired are often used as collateral for the loans, along with the assets of the acquiring company. The main advantage of an LBO is that the acquirer can purchase a relatively large stake in a company using very few of its own assets. A PE investor generally looks to buy a large stake in a well-established private company. Once they buy this large stake, they tend to look for ways to improve the way the business operates. And then once they improve the business, they look to sell this stake down the line to a larger investor. Because PE funds generally operate and buy stakes in other companies using a lot of debt, it is a risky way to fund the venture. If the acquired company's cash flows are not sufficient to pay the debt taken out by the PE fund, then the assets of the acquired company are held on the line. Generally speaking, PE funds do not invest in the newest hot tech of the day. They tend to look for well-established, unsexy companies that they know they can turn around and improve the business. Most PE funds generally look at single-ticket investments of close to $100 million, and they look to turn around the business that they've invested in within a period of 5 years and exit the company. Some of the top players in the PE industry include Blackstone, KKR, the Carlyle Group, TPG, and even CVC. Some well-known Indian players are Kedara Capital, Chris Capital, and multiples. Next up, let's talk about venture capital. The approach of venture capital investing is fundamentally different from private equity, in that VC funds help entrepreneurs build their business up from the starting stage. They do this by giving startups huge investments that help them scale. They give these startup businesses technical advice as well as industry advice when they're scaling up their business. And they provide startups with a network required to hire the right talent as well as get the right business advice when it comes to scaling up and growing their business. Similar to private equity, VC funds also look to invest in private companies, but all the similarities end right there. VC funds tend to make investments that are much smaller, varying from $500,000 to $50 million, depending on the stage of the startup. When it comes to horizon of investments in startups and venture capital, they tend to be longer than private equity. Generally speaking, in the Indian context, exits tend to happen after 10 years. So most funds tend to offer investors a 10 years plus 2 years extension structure. Whereas if you're a venture capital fund based out of Silicon Valley, and I'm talking about the one in San Francisco, the horizon of each fund tends to be around the 7-year mark. The main way for venture capital funds to make their money is through exits, and these exits generally happen by selling their stake to a larger venture capitalist fund, a late-stage private equity fund, or even through mergers and acquisitions and IPOs. Some of the top players in the Indian VC scene are Axel India, Peak 15 Ventures, Bloom Ventures, and Matrix Partners. So we talked about private equity and venture capital. Next up, let's talk about hedge funds. A hedge fund is a type of fund that invests in public markets, but their investments are not only limited to equities. Their investments can be currencies, commodities, real estate, and even derivatives. If you wanted a very simplified comparison, you could think of hedge funds as a day trader, whereas PE and VC funds are more like long-term investors. Hedge funds have a strategy that they follow. It could either be global macro, relative value, equity market neutral, or even short bias strategies. Investments in hedge funds are generally not locked up the way they are in private equity or venture capital, which means that hedge funds have to have a much shorter investment horizon. On one end, you have multi-manager hedge funds such as Citadel, Millennium, Point72 that invest over 3 to 9 months based on a company's quarterly earnings. The time horizon of a hedge fund investment varies depending on the type of the fund. And on the other hand, you have deep value investors and activist funds that invest over a multi-year holding period. So hedge funds are really all over the place, and the time horizon depends on the investment style of the manager. However, most hedge funds are moving towards a shorter horizon investment period because investors are getting increasingly impatient waiting for the right returns. One of the biggest risks that do come up when investing with hedge funds is that the money in a hedge fund is not locked up, as I mentioned before, which means that it's not as sticky as it is in PE or VC funds. So when there's a downturn in the market and everyone is scared about losing their money, hedge funds could be even more severely impacted because investors might call back their capital, and if the hedge fund had deployed all of its money in illiquid assets, then they'd be forced to sell these assets at fire sale prices. Some of the top players in the hedge fund industry include Ray Dalio's Bridgewater Associates, Nathan Anderson's Hindenburg Research, who we all know because of last year's Adani reports, and Citadel Partners. So I know that we talked about a lot of things right now, but let's just try and summarize. Private equity can be thought of as a blanket statement for funds that invest in private businesses as opposed to businesses that invest in the stock market. Under private equity, we can have PE funds and venture capital. PE funds invest in established companies that have already got a well-operating business model. And venture capital funds tend to invest in startups, early stage startups. Both VC and PE are long-term investment strategies. They generally tend to see exits after multiple years of holding the businesses. Whereas hedge funds are a type of fund that not only invest in equities, they invest in other types of asset classes such as bonds, commodities, and even currencies. Because of impatient investors, hedge funds generally tend to cater to a much shorter term investment horizon. And there you have it, a simple video that explains the difference between PE, VC and hedge funds that you can now use and explain to even your grandmother. Thanks a lot for watching, dear friends. I really hope that you enjoyed this week's cup of coffee. And if you have any suggestions about what you'd like to see next time at Filter Coffee Finance, do let me know. Don't forget to like this video and subscribe to this channel if you got some value out of it. And until we meet again, this is Filter Coffee Finance signing off.